Yeah. So good morning to all. On behalf of the Academy, let me welcome Mr. Saurabh Ghosh, who is here with us today this morning in spite of his busy schedule. And I extremely thank him for that. Thank you, Mr. Ghosh, for being with us. Mr. Ghosh is going to talk to us about uh, overview of central bank, money, and financial markets. Before I hand over the session to him, let me, I have the privilege to introduce you our speaker today. Mr. Ghosh is the Director, Strategic Research Unit at Reserve Bank of India. He has published several research papers in reputed journals. One of them which I saw was monetary policy transmission in India, and it's a very, very important topic. Okay, then he has contributed a lot in through several RBI committees to CHN banks and other institutions. He has a very rich experience of working with RBI for more than 20 years and participating in various RBI committees, of course. And more than that, I would like to share with you that he is a very, very scholarly person, because if you will see his education background, he has graduated throughout from reputed institutions, which are the sought institutions, and where getting admission is very, very tough, and it's purely on merit. For instance, he has done his masters from Delhi, from JNU. Then he has done his PhD from IGIDR, that's Indira Gandhi Institute of Development Research. He has done CFA from US, and yes, so that's his background. Now, I would just like to add here to students, up to now you have been reading monetary policy, quantitative techniques, qualitative techniques from textbooks, right? But today we are lucky to meet an expert who is actually implementing your monetary policy and is a member of the team who works on the monetary policy and maintains the stability of the economy. So thank you once again, Mr. Ghosh, for being with us this morning. And I request you to start the session.
Yeah, thank you indeed, madam. Am I audible?
Yes, you are.
Okay, great. So it's a privilege to take a session in this esteemed institution. Thank you very much for giving me this opportunity. Thank you for your kind words in the introduction. I love to teach, and there is always a two-way communication, which I believe in. Therefore, while I go on speaking about this short introductory or orientation lecture, what I would request you to basically make it interactive sessions. So we will discuss, and that's the best way rather than going through a PPT. I hope that's fine with all the participants. I'm not able to see the participant list here. However, that's fine. And there's another caveat that I must add. These are all my views, and whatever I'm discussing here, it's on permission. So certain topics I can cover, certain topics I cannot cover, because that's not the kind of permission that I have taken on my office. And it is all my view, it is all my personal views which I am discussing. I would request you to kindly not to quote or not to share these on the say RBI representative was saying, or this was the view from RBI. You can always discuss. This is for academic purposes and for your understanding. This is not RBI's view. This is not the institutions I belong to their view. This is an academic session for our understanding and discussion. Is it okay? I would request all of you to kindly please unmute and please be interactive. Otherwise, the session starts becoming very boring.
Yes, sir, it is
Is
fine.
it
Yes,
okay?
Yes.
Yes, sir.
Definitely.
So, how many of you are in this? Actually, I'm not able to see the participant list. That is why I'm asking. How many of you are in this lecture?
So
We
there are
have
47
47.
total participants.
Yeah,
Great.
there are
And
7 students. And yes, I assure you, this will be only an academic interaction. And I mean, we understand the constraints. So I think you don't have to worry about it, Mr. Ghosh. Yeah.
that's perfectly all right. Thank you very much. And you are joining this in the master standard, or what exactly you are joining this courses for your master's orientation program?
Yeah. Yes, it is their post-graduation diploma in economics and data science.
Post-graduation diploma in economics. All of you are from economics background, or some of you are from engineering and other background? Is it multiple discipline that is there, or you are basically, most of you have done your graduation in economics? If there are someone who is from engineering background, or
So some of us are from
kind
engineering,
of
sir.
say, great. And so we will keep the lecture at a level where it will start from the very basics of it. It's an orientation thing. It's supposed to take a bird's eye view into the entire gamut of these things. But please feel free to interact, and everyone, not only a handful of participants. Some way or other, I want to interact with all 46 of you in some point or other in this 1 hour. So please unmute, please feel free. For just the convenience of bandwidth, after this, I will stop sharing my video. But you please come switch on your mic, switch on your video if it is convenient. And let us discuss and understand this. This is not a part of your curriculum, if I understand correctly. The whole idea is to take you through the idea of central banking and how central banking is impacting your life. So it will be great if you kind of keep on interacting and giving your feedbacks to me. That will really help in this session, and all of us will learn, including me. I will learn from your experiences. Now, again, another logistical statement before I start this lecture. The logistical statement is that this entire lecture is taken in 3 semesters, so you can kind of expand this to a great deal, but I have tried to summarize this into a 1 hour session. So of course it's going to be could be a little heavy. We need to stop and understand certain things. It's fine if we even cover half of this lecture, but if you are not understanding something, please raise your hand, or please feel free to ask questions. That will help everyone. So I'll start sharing my PPT now, if it is okay with all of you, and please give me a feedback that whether you can see my PPT. Okay?
Sure, sir.
Yes, sir.
Is it visible?
Yes,
Yes,
sir.
sir, it is.
Yes, sir, it's
I have
visible.
to-
Yes, sir.
Great. Thank you very much for interacting. Now, how do I reduce this? Otherwise, you will be able to see this one also. So that's fine, I suppose. Great. So basically, our topic for today is central banking, money, and financial market. First, let me start with the basic question that what are you expecting out of this? What is the first thing that comes to your mind when you listen to this? Anyone, please. There is no correct answer. We are not in MCQ setup.
The first thing that comes to my mind is RBI, because it is our central bank.
Okay,
Some
Great.
monetary policy.
great. What else?
So the role that
Anyone
a
else?
central bank, so the role that a central bank plays when it is interconnecting money in goods market and financial market.
Very good. Actually, you are pitching your question at a far higher level than I expected. And this is expected of you guys because you are far advanced level of learners. Anything else that comes to your mind? Anyone else would like to tell me?
The interest
Sir,
rates.
Yeah,
please
please
go
go on. Interest rate. What else?
Maybe how
else would also...
maybe how central bank regulates the money and the financial market.
Very good. So almost we are there. What we will start, the basic question that we are going to start is that why central bank? Has this question ever come to your mind, that why at all a central bank is needed? After all, taxpayers' money. Every government is spending so much of money in maintaining the central bank, in paying a person like me that how much do I salary and everything. There is a large institution which is there. And the second question is the question relating to you. All of us are using currencies, money, monetary system. So the question that is inherent in our mind and that should strike you, that after all, what is money and who supplies money, right? So let me go through, let me start with this. And when I talk here, I'm basically taking a bird's eye view. As I told, it's a heterogeneous crowd. So I'm starting from the very basics, okay? So basically, if you see, central bank is a sort of crisis management institution. If you see, most of the central banks were established after a major crisis or crisis in the world or in those countries. For example, Bank of England was established in 1690 when there was a crisis in that country, when they wanted more money and when they wanted money from a group of person or a central banker who were rich, who could solve their problem. Fed also, so Bank of England came when their war was going on. So some institution was required to finance the war, whom people will trust and give their money. This word trust will come again and again in the lecture. And I will show you that everything that is there in the financial market depends on trust. The next one is Fed. Fed came into existence when there was this banking panic of 20th century in US. Central banking is largely a 20th century phenomenon, but there are certain central banks which started before 20th century. And there are certain things that central banks do. So if see, you guys will go for your job interviews, you guys will go for many other written exam or things. So the first thing that you should remember, that very simply, before going to any nitty-gritties, that a central bank's main objective and main thing is to, in a way, control or supply the monetary system and credit in any country. As we go to more and more professional kind of central banking duties, and as it has kind of originated in different sectors, we see that central bank will more and more come to this monetary stability front, financial stability front, and in supporting the development role. Now, my next set of questions. I want 4 to 5 of you to volunteer and tell me that what do you think should be the central bank function? In particular, these are the broad functions. So if you have to name what it should be, let me start with the most common one, that is currency management. Everywhere on the notes, you see the central bank stamp coming in, and everywhere there will be a promise of the central bank that this, say on the greenback or dollar, you see the promise of that treasury is ready to value this as $10 note, or ready to value this as this. Now, this is one function of central bank, that is currency management. I want 4 or 5 functions to come from you. Volunteers.
So it
determines the reserve requirement of the banks in order to control how much money supply is there in the economy and to control inflationary pressures in the economy. So how much reserves the commercial banks need to keep with them and keep with the RBI as well. So that's one of the things.
Yeah, great. Very good. It's actually in the bullseye. But there are some other functions. If someone else would like to volunteer.
So it's
You are absolutely correct. Yeah, please go on.
so it's the banker to the government.
Great. Very good. Anything else? So bankers to the government is coming from exactly here, that government needs more money and there was a crisis period and it's there, So anything else that you can think of?
It's a banker to commercial banks as well. So it lends and borrows money from commercial banks through repo rate and reverse repo rate.
Actually, whatever I thought I will be covering. So my teaching is very easy. Actually, we can just chat for some time and stop this lecture here itself. But anyway, since I have prepared this slide, let's go on a little bit. Anything else that you want to highlight?
The lender.
Sir, it is the lender of the last
It is a
resort.
custodian of foreign exchange reserves.
Very good, very good. Lender of last resort, custodian of foreign exchange reserve.
Yeah.
Anything else? You have almost covered everything, and I have nothing more to say.
So,
Great.
exchange rate, so controlling the exchange rate.
Okay, great, very good.
It also it has monopoly of note issue.
Yeah, very good. Absolutely.
Yeah.
Market operations.
You can also name it as the head of all the other banks that we have, like for
Great.
head for
Great.
State Bank and all.
The central bank also plays the role of the clearing house of the.
Absolutely great. Absolutely great. Means I have nothing more to say actually. Yeah,
But
please
it
go on if
also
someone else
controls
is there.
it also controls the way credit creation is done by commercial banks, basically
good.
by engaging in open market operations or CRR
Very good.
processes.
Actually, I must say I know that your institution is very good and very good students come here, but I'm really surprised. Trust me, and this I'm not saying for any other reason. I didn't know so many things when I joined my MA class in JNU. Of course, it is long back, almost 2 decades back, but I didn't know so many things about central banking, which you shared with me. Fine. So I move on to my next slide. See, banknote issuance, one of you have already told me. Banker to the government, you have told me. So what is banknote issuance? We have monopoly power. We are the only authority to print. What is banker to the government? Banker to the government means whatever government, we maintain government's account. RBI maintains government account. And when I am giving this lecture, I am not only talking about RBI, I am talking about the most important central banks around the world and also RBI. Okay, so don't think that I am only talking about RBI because I am from RBI. When I am only talking about RBI, I'll come to that, right? So it is banker. So bank account of the government is with us. Whatever tax collection, whatever thing that comes, it's like your bank account only. Whatever balances is there, whatever bank government is receiving payments, tax revenue, anything that comes to us. And then whenever government is drawing that check, that goes from RBI. Okay. So that's a banker to the government. Bankers to bank means what? All the banks have an account with Reserve Bank of India. So suppose one of you have an account in ICICI Bank and I have an account in SBI. So when this ICICI Bank and SBI is transacting, they are transacting through payment system. Here RBI is there. So one bank's account will be debited in RBI's account with them and one's bank account will be credited. So this is how the transaction takes place. RBI or the central bank stands in between. Okay. So this is the bankers of the bank function. A related function is the clearinghouse function. What I told you here, that is also coming as a clearinghouse, right? One of you already told me the lender of last resort. So what is lender of last resort? When there is a huge problem, when there is a liquidity problem, so the banking system will collapse if they cannot give you your deposits back at time. So the Reserve Bank or any central bank can chip in, and for the short time, it can make the money available so that the liabilities are met. What is bank's liability? That is you depositors. You go to your ATM, you can draw money from your ATM and pay for everything so that there is not a panic or not a crisis setting in. One of you also told me about the banking supervision function. What is banking supervision function? It's kind of an auditor function. Banks are maintaining their account, whether banks are following all the guideline and everything. That's most important. And of course, we have monetary policy. So the interest rate on monetary policy that we move is of course included here. So I think some of you or most of covered most of the points. These are the main central banking function. If any of you have any query on this particular slide or anything that you may not have exact idea on, a sketchy idea, please feel free to ask. Any questions?
Yes, sir.
Okay. If there is no, yeah, please go on.
What does clearinghouse of commerce mean?
So clearinghouse of commerce means, see, all these transactions are taking place, right? So you are drawing a check, right? You must have drawn a check. Now this check comes to the clearing corporation. This clearing corporation is maintained by most of the central bank has this clearing corporation. So that check will be produced. There are systems which will kind of see whether the check is genuine, the check is true or not. The check will be digitally sent to the bank for signature and everything correction. And then if everything is fine, then the transaction will be settled between these two organizations. So the entity which is doing this entire function and then maintaining a copy minuscule, basically this is a digital copy of check that they maintain, is clearinghouse. Clearinghouse has several other functions, but I am just simplifying this in a check transaction kind of a thing. Is it okay?
Yes, sir. Okay,
Rituja?
thank you. Yes.
Okay. Okay. Anything else?
No, sir, that's all.
Oh, thank you. So we go move over to the next slide. So see, we were saying that it is a 20th century phenomenon, but sovereign risk bank was the first in 1668 to have a central bank. Bank of England was having a war and it had to have the organization which will finance the government for this war. So in 1669 it came, and after that Bank of France followed. Then it was a European phenomenon that Bank of Spain, Bank of Japan, Federal Reserve System was in the early 20th century, then Bank of Canada, Reserve Bank of New Zealand, and Reserve Bank of India in 1935. Okay. So it was during the British era, of course, before our independence. And then one of the last central banks to come was Reserve Bank of Australia. So you see, most of the central banks were set up, most of the major central banks were set up in the 20th century. Now, the question is, almost all the countries around the world have a central bank. Then the question arises, and which I expect from you, is that, is there a country which you know which doesn't have a central bank?
So is it Venezuela?
Okay, that is a good answer. But any other answers?
Afghanistan?
That's great. Afghanistan doesn't have a central bank so far. Any other country?
Hong Kong?
No, Hong Kong has a central bank. Hong Kong Monetary Authority.
Sir,
Again,
Micronesia.
a good guess.
Sir, Micronesia.
I don't know, but frankly speaking, I don't know whether they have or not. But three countries that do not have central banks, which come to the literature, is Afghanistan, Cuba, and North Korea. Okay, so now let us move on. So let's again discuss. Now, from the central banking, we will enter the domain of monetary policy. So what do you think monetary policy should do? What the monetary policy should achieve? Again, very
So
quickly,
controlling
because
credit.
okay, fine. Please come
Price
quickly because we
stability.
have to go to a long area, and quicker you give your answer, I can move on to the slide quickly. I will take feedback from you and then I will show what I have in my slides. That's going to be the thing. So if you want me to cover fast a long area, then keep on responding fast and I will take 4 or 5 of your answers and then I will go into the slide that I have and we will explain. That's the way we are going to cover this. Is it okay with you guys, or you would like me to cover the slides quickly as far as I want to go? It's up to you. Let me know.
Okay. Sir, hello.
Yeah, please go on.
Is it price stability, low inflation, and maximum employment? So basically,
great. Some
The
answers, please.
monetary policy controls the interest rates.
Okay. Then.
So to control the demand and supply of money.
Great. Then.
So monetary policy, in my opinion, should have 3 roles. One should be maintaining unemployment at natural rate of unemployment. Second should be low inflation. And third should be maintaining high real GDP growth.
Okay, great. So
So
again, I have almost
may it also be used to influence exchange rates.
Okay, very good. Again, when I'm talking, I'm not talking in general for RBI. I'm talking the central banking role. Okay, so you can you don't have to consider only RBI. Go on, please.
So according to me, it should be like that the role of the central bank is to maintain the inflation stability, like price stability. Plus, at the same time, it needs to help with the GDP growth so as to have a decent supply of credit for the investment purposes and all, in turn leading to GDP growth, employment. At the same time, very important is to take a key role in the governance issues of the banks. It has to hold the governance part as well of the banks, like how the banks are working. And
so now we are that governance part of the bank. It's a very good answer, Chetna. But now for the time being, that was in the role of central bank, previous slide. Now we are concentrating on this block. We are now narrowing down because this is a lecture more on the monetary policy kind of a thing. We will discuss this entire thing. Now we are talking about monetary policy, but I completely agree with you what you are saying. So the governance of the bank here comes under the monetary supervisor role. We are now going to monetary policy in more detail because this lecture is supposed to be on central banking and monetary policy overview. Okay, but you are absolutely right. There is absolutely no problem in what you have said. Okay, so basically, monetary policy, what should be the goals of monetary policy? When we talk about the goals of monetary policy, okay, sorry, there was some, so when we talk about the goals of the monetary policy, the goals are basically price stability. That is what you are maintaining, that low inflation and everything comes here. I think many of you mentioned this growth. So growth is a prime objective today. You will see that when the speeches are coming and everybody is coming in this pandemic situation, growth along with price stability is becoming very important. Financial stability also play a very important role. You know from where this financial stability thing explicitly started coming in RBI, in central banks domain after the global financial crisis. Have you heard about global financial crisis? I'm sure you have. Okay. Then,
yes,
then
sir,
optimal level of 2008. Very good. So then comes the optimal level of employment. The optimal level of employment is somewhat related to growth. Can you say by which law the level of employment and growth are related? It's called Okun's law.
Okun's law.
Yeah, that's correct. then a bit of egalitarian distribution of money in certain central bank. Again, I am not saying it's RBI, in certain central bank. And a related concept once again is welfare maximization that some central banks stop at. Again, in this slide, you people have almost covered this and I didn't have to say anything kind of very new here. But if any of you have any question on any of these aspects, kindly feel free to ask. Questions? No questions?
I have a quick question. Are the last two objectives, welfare maximization and egalitarian distribution, mutually exclusive? Because, like, can they both be done together? I feel like there could be a conflict.
Well, that's a great debate which goes on, and the entire development economics comes into that egalitarian distribution and welfare maximization are not the same. Now, since we are discussing central banking policy, we will not get into that great debate in particular, but you are absolutely right. There is an entire literature, there is an entire stream of studies that considers here. For the time being, we are assuming that, well, this can be done together and a person can, and a central bank or institution can manage that. Okay, then we move on to this. See, when you are doing this, these are fine, these are goals, okay? But in order to achieve these goals, you need something, some tangible kind of a thing. Say welfare maximization per se, I cannot define welfare maximization. I don't have an utility function. Well, we have utility functions, but it is not observable. But inflation is observable, you know. So, or monetary, the quantity of money is observable. So when you have to achieve the goal, you have to achieve in terms of something, right? So when we talk about this in terms of something, we come to the terms called monetary targeting or inflation targeting. I'm sure that many of you must have already heard about this term, but allow me for the completeness of this lecture to go through this in a very summarized kind of a way. So basically the entire thing started from Milton Friedman, that it is say monetary targeting, a particular growth rate of money. So money will be targeted. It is M3 or M2 that will be targeted by the central bank. They will provide a particular growth rate of M3 and M2 that will help them, or that will kind of lead to achieve the goals that we have seen in the previous slide. Now, the main thing, we will come that what is the trade-off between these two, but let us understand the another block, which is the present block and which is mainly known as inflation targeting or flexible inflation targeting. There, countries set an inflation target of say 4%, plus minus 2% kind of an inflation target, and then try to achieve this inflation target using the monetary policy tools, you know. So this is in nutshell what is flexible inflation targeting. Why it is flexible? Because it has a band and there are some fixed inflation targeting numbers also. Some country follows a number like say 2% or so. Are we clear on this slide? Any questions? No, we can move over to the next slide. Sorry, this diagram has come a little bit of this thing has come here. Anyway, basically why we are presently mostly the central banks are moving from monetary targeting to inflation targeting. What is the reason for that? You have a money demand function, which is a function of income, interest rate, and inflation. But as we were advancing, many credit cards, debit cards, electronic modes of transaction, and many other features were coming up. What has happened? This money demand function, which determines that delta M that we have considered in the previous slide, that started becoming unstable. That was difficult to determine how much is required. Therefore, slowly what happened? Central banks started concentrating on this inflation targeting framework. It was basically very easy to account. You have a number which you can follow. You get the inflation number for every month. Yesterday, inflation number was released. Can anyone tell me what was the inflation number?
So 5.6%, I guess.
5.7%.
No, I think 5.53, something like that. So it was in the 5.5 range. So market was expecting a little bit more, but we got an inflation number, which is more soothing. So as a student of economics, you shouldn't miss out certain things. One is inflation number. Second is growth number. Third is IIP number. Fourth is exchange rate number. Fifth is government securities yield. These are some of the common questions. I have been in several interview boards, and these are some of the common questions where people test that what is your knowledge of economics. These are very trivial, you know, but it is like if you say this correct, people will say, okay, this is fine. He or she is expected to know this. But if you somewhere miss these numbers, then in the interview board things go a little bit haywire, you know. So it's not a part of this course, but I just thought that to share my experience in other fields also with you, because you are very young and you will face interview boards, you will face many other boards. These numbers you should always keep in your mind. So anyway, let's come back to this slide. And inflation target, the advantage of inflation target, you know, inflation target is like accounting identity. You have inflation number. So if it is your target upper range is 6%, you can immediately say it's below 6%. If it is above the say if your upper limit is 5%, you can say that inflation targeting something needs to be done. So because of its operational flexibility, everyone has some way or other stuck to this inflation targeting numbers for most of their time, you know. So having said that, is it okay? You are with me? All of you?
Yes, sir. I have
Yes, sir.
Yes, sir.
I have a quick question, sir.
Sure, please.
The transitioning from monetary targeting to inflation targeting, you mentioned about the fact that the monitoring thing, or it's a function of 3 parameters. Now, is it because there are too many parameters involved in determining this delta M, and that's the reason we are shifting towards the inflation targeting, where maybe the parameters are low and there is like little less uncertainty?
Yeah, basically it's a very interesting question, and a lot of debates are already on this, okay, and there is no unanimous answer. But if you ask me, I will say there are several factors. One is digital revolution. So how much money will be needed? It's very, very, very difficult to say with this digital revolution, because I don't know what mode of transactions you will be using. Second is demographic character. When the demography itself is changing, it's very difficult to estimate this function, because with age and with time preferences, we kind of behave differently, and it's completely dependent on how we react to. It's basically the elasticities: income elasticity, interest rate elasticity, and inflation elasticity. So these numbers keep on changing. So there is a huge kind of literature on this, that what is making this change. But what is important for us at this juncture is to understand that it is changing, and how much money you will supply, it's not very easy to predict. There is a lot of gray area there. We need something more accounting, and something which everyone will know. Like say inflation number, everyone knows that it is 6%. So we don't have to spend much time in, it's view it from operationally, you know, someone has to make decision. Now you say, I go and say that, okay, money demand function hasn't changed. You have to supply 100 rupees. Someone says that it's absolutely changed. You have to supply 200 rupees. There are many voices. Here there is one voice that, okay, inflation is 6%, inflation is 6%. So you are above the inflation target or below the inflation target. Am I, could I convey what you ask, or there are some other questions?
Yes, sir, it makes sense. So just another quick clarification, just wanted to understand. when you talk about 6% inflation rate, that's the 6% of the overall GDP amount. Am I correct in interpreting that?
It is 6% CPI inflation.
Okay, that's a consumer price index.
CPI is consumer price index. Okay.
Okay, all right.
Okay. You will find the CPI entire data set in MOSPI site. You can find also in RBI site. Okay. It's a good effort to just visualize this data that how our inflation path has changed. Okay. This thing also came up in your discussion before, that what are the tools available in the kind of with our general central bank. It's money supply, it's of course credit is a part of money supply, interest rate, exchange rate. Question is, can you tell me some countries, see money supply, most of the countries, you know that money supply, credit, you know, interest rate, you know. Give me one country that targets exchange rate as a monetary policy tool.
Philippines?
Nepal.
Any other guesses?
Sir, China.
Not officially. Okay, so it is Singapore. Any reason why it does it? Because it is a small island economy, you know. A major portion of it is export and import. So if they are controlling exchange rate, they can control inflation, they can control output, they can control many other things. Make sense? Actually, there is some saying that for Singapore, you don't need to know much. You just stand in any of the harbors or any of the ports of Singapore and see how many container ships are standing there. You will get a good idea about that countries. Make sense? Okay.
Yes, sir.
Great. Okay. So again, what is monetary policy? As you know, as we have already discussed, it is the money supply that central banks were doing so far. But now mostly it is done in terms of interest rate. We are in the interest rate and inflation targeting country. So I have this question. If you can answer quickly, it's fine. I'm going to cover everything. But again, I would request you that what are they? When are they changed? Why change them? How effective? Are developing countries different? Is this the only instrument? Any ideas or any answer from your side?
So what are they can be answered by the short-term interest rates are the repo rates, that is the rate at which commercial banks borrow from central bank.
Great, very good. Next, when are they changed?
Sir, to also maintain depreciation of money, so to control the exchange rates.
Okay, so Singapore will be doing that, right? Okay.
Yeah.
So, and when are they changed?
So the Reserve Bank Board of Governors decides when the exchange rate interest rates are to be changed, in my view.
Sir, it's changed. Yeah, it's bi-monthly.
Bi-monthly, like once in 2 months when the NBC
Great,
sits.
great, great. Very good, very good. And why change them?
To slow down or speed up the economy.
Depending on the objective that we want to achieve by changing them. So
basically to increase or decrease the money supply that flows in the overall economy.
Absolutely correct. So if we are in an inflation targeting framework, if inflation is above our band, what we will do?
So we will increase the interest rates.
And if inflation is below,
we will lower the rate.
That's great. You all know monetary policy. Why madam called me to take this lecture? You know better than me. How effective? Whether they are effective, how do they work? Any idea?
So monetary policy transmission mechanism, so it gets transmitted through the market rates, but it takes a little bit of time.
So you're talking about long and variable lags. Right.
Right,
Very
sir.
good. Okay. And is this the only instrument?
No, I think we can also have some tools from the fiscal policy, if I'm not mistaken.
Absolutely not.
We can also try the reserve requirements.
Absolutely on the dot. But now we are concentrating that whether central bank has any other instruments.
Yeah, so to control money supply, open market operations, like to control the money supply.
Open market operations, bonds and
Open market, closed market supply.
Great. Almost you have covered everything. I have nothing more to say. Great, Shavik, very good. Liquidity adjustment facility, extremely good. So you have almost said everything. Very encouraging discussion. And let me now take you through systematically that how I connect whatever you have said. Okay. So short-term interest rate is the main thing. And then you have reserve money and money supply changing, your open market operation, liquidity, everything comes in this domain, you know, all these things are related. Okay. So now we are now diving into the core of monetary policy and central banking. Okay. All of you know national income accounting identity, right? What is national income accounting identity? Y is equal to bolo.
C.
Y is equal to C, which is consumption,
minus N.
I
plus G.
G. For the time being, we are not considering. G is autonomously given. We are not changing G. Plus
export minus import.
Yeah. Now, this is also aggregate demand, right? Central banks operates by changing the aggregate demand curve. So let me draw it here. Say this is AD1. Okay. And this is SS. We are not going to change supply for the time being. Now suppose inflation is 8%. As a central banker, I need to do what?
Raise the short-term interest rate.
Reduce the money supply. Reduce the aggregate demand.
Yes, absolutely right. Rate the short-term interest rate. So what will happen when you reduce the money supply?
Purchasing power.
Aggregate demand would be reduced.
You will reduce the money supply by doing open market operation, right? What will happen when you reduce the money supply? When you reduce the money supply by doing open market operation, interest rate will rise or repo rate will rise. Or you can just go and announce the repo rate. Suppose I announce the repo rate that I am increasing the repo rate. Now, increasing the repo rate some way or other has to work with these three channels, right or wrong? What is our objective? See, this is price, this is output. Now, we have to some way reduce this aggregate demand here because this price is 8% or inflation is 8%. I am not okay with that. So I want to change this inflation somewhere near 6%. What is my inflation target? So what am I ultimately doing? I am ultimately pulling the aggregate demand down, right? So that my inflation now becomes 6%. Output also will fall here, say 2, this is 1. So if I want to bring this aggregate demand down, then I have to reduce consumption. I have to reduce investment. I have to reduce X minus N, that is net export, sorry. So how do I reduce consumption? Interest rate goes up. So consumption, when interest rate goes up, the borrowing will be lower. Say personal loan, purchases of computers, purchases of many other things, taking EMIs for something will be lower, and this consumption will come down. Okay. What happens to interest rate investment? Investment has two channels. One channel is that the firm's profit goes down. So firms will make less investment. Okay. The second avenue is that the cost of borrowing goes up. Interest rate has gone up. So investment has come down. Right? Right? You are with me?
Yes, sir.
Yes, sir. Yes, sir.
So this is the way investment will come down. What will happen to export minus import? Export minus import depend on exchange rate, nominal exchange rate. Now, when you increase this interest rate, nominal exchange rate generally appreciates. That is, foreign good becomes costlier. Okay. So when foreign good becomes costlier, your exports will come down. Right? So there also export demand is going down. So what will happen? Aggregate demand will fall and your prices will come within your range. I want to understand, and this is the crux of what you need to learn. I want to understand whether you understand every bit of it. I am ready to go 5 times on this particular slide, but understand it. This is the crux of the will that is there. Rest all we can discuss, we can do. In an overview section, if I am able to bring you to this one and make you understand about this, half of my work is done. Please tell me, voice your opinion, that whether you agree with whatever I have said, you disagree, and you have understood. I want a yes from all of you. You
Sir,
can
one
put
quick
on the
question.
chat box also. Sure.
So when you talked about this consumption coming down, there's one more aspect to it, maybe where, because the interest rate goes up, the inclination to saving increases. And so people are more likely to save rather than to spend. That is one aspect. Also, can you also clearly explain, the relationship between nominal rate and its influence on the exchange rates, please?
Okay. Anything else?
No, sir, that's it. Rest, I have actually followed everything.
Okay. Anything else from anyone?
So can you please repeat the like export minus import part also? How that is decreased.
Okay. Anything else? I'm just collecting the questions so that when I go through next time, I can come and address everything.
So I had a question regarding consumption. Let's say I am a
Yes.
I am a citizen targeting a fixed consumption target every month, and let's say the interest rate goes up, then I need to save less money in the bank to get the same amount of money back after 1 year, which I was getting before. So I can afford to consume more today and save less in the bank, right? So consumption can go up by that metric as well. So how can we be sure about consumption going down? That would be my question, sir.
Okay, fine. Very interesting questions. So can I start answering? No more questions? Fine.
Sir,
Let me
can
start
you
with the
please,
consumption.
sir,
Yeah,
can you
go on,
please
please.
elaborate upon the two ways in which investment is impacted? The
Sure.
two methods
Okay.
you said. Yeah.
So let me start from consumption, since consumption is fine first. And if it is clear to you, you will then say it's clear. Then only I'll move over to the next part, or I will stick to the consumption. See, when we are saying the decline in consumption, it is the net decline. So there will be several agents in the economy. For someone, okay, what you are saying that they will consume more and save less because interest rate has increased, whatever target income they are trying to achieve from the banking sector, anyway they are going to achieve. But overall, if you aggregate the entire economy, we have seen that consumption due to an increase in interest rate declines. There could be some person for whom consumption is increasing, but if you take the entire macro economy, then consumption declines when interest rate increases. That's a limited point. Are you okay with this?
Yes, sir, it's clear.
Okay, fine. Now let me come to the investment question. See, investment operates through two channels. One channel is the cost of investment, where say you make an investment of 100 rupees. If R is equal to say 10%, then every month you have to pay 10 rupees as interest payment. It goes up to 12%, then every month you have to pay 12 rupees as an interest payment. Now there is an IRR schedule which goes like this. If it is cutting here at say 10% level, it cuts here at 12% level, investment goes down. If we don't go to the IRR schedule, it's as simple as this. Now every year you have to pay 12 rupees, say 12 crore. But suppose you are generating 10 crore, then you will not take up that project. So our CA will do this evaluation and say that in this high interest rate situation, I don't think that you should go for this project. Let us take a very simple example. I am sitting in Fort area. So for opening a restaurant in Fort, say 2 crore will be required. Now 2 crore at 10% interest rate will come to something around 2 lakhs interest payment. But say it goes up to 12%, then there will be an increase in the interest payment. Now there is an assessment that you cannot have so many customers for which you can pay this interest. Therefore, I'll deter for making that restaurant and I'll not open that restaurant. So investment is falling from that channel. This is called interest rate channel. Am I clear on this one? This part you have understood?
Yes, sir.
Okay. The second part is as follows. I am already an existing company and I was earning say 100 rupees, out of which I had to pay 20 rupees at interest before. So I had 80 rupees. This was my profit. I was thinking to make 10 rupees available from this profit for another business venture, say a courier service. When I am taking this rupees, these are all in crore, but you can understand unit doesn't matter here. Now interest rate goes up. I have to pay 30 rupees interest. So my profit goes down to 70. Then I don't have that 10 rupees to make that additional investment in courier services. So this is the second channel. Am I clear?
Yes, sir.
Great. So now I can move on to the exchange rate thing where there are certain questions, right? Tell me something, what do you understand by exchange rate?
The rate at which we can purchase the currency of another country using the local currency.
So today, say, exchange rate is 70. And I was purchasing one cigarette for $1. So I was paying 70, right? Tomorrow, or let's not take the cigarette example because cigarette example is nowadays avoided. So cigarette smoking is injurious for health. So let us move on to something else. Let's say that I was purchasing one Pepsi, which is $1, and which was I was paying in India 70. Now suppose $1 increases to 75, right? So now for that same Pepsi can, I have to pay 75. So when rupee is depreciating, this is depreciation of rupee. When rupee is depreciating or when dollar is appreciating, then import is falling. Am I clear on this part?
Yes, sir.
Yes, sir.
Is it okay? Fine. Now let's see export. The same thing has happened. So I was perhaps selling a handicapped item in US market for $1, for which I was getting 70. Nothing changes, but only rupee depreciates. Then this, for the same thing, same everything, I get 75. So my profit increases by 5 rupees. So when rupee depreciates, I will export more or I will export less?
Export more.
More.
Export more.
Correct? Now you see, suppose interest rate declines. If interest rate declines, foreign capital flows will go up or will go down? Foreign capital flows were coming to our country to take advantage of this high interest. Yeah, it will go down because they were coming to earn interest. Now interest rate has gone down. Like your deposits will be less, they will also bring more or less capital. It is very simplified. There are many complexities in this, but I am making it very simple. Now, if foreign capital is go down, then what will happen? Dollar rate, which is the price of dollar, will go up or go down?
Go up.
See, the supply of this particular thing is actually going down. So you have short supply of dollar. So dollar prices will go from 70 to 75.
Yes, sir.
Right? So when interest rate goes down, we have seen what happens here, right? When rupee goes from 70 to 75, our export increases, our import declines. So net this becomes positive. Correct? Here we have seen this. Correct?
Yes, sir.
Yes, sir.
So now my rupee has gone from 70 to 75. That means my export minus import from here is going to be positive. Correct or wrong?
Yes, sir. Correct, sir.
Okay. So if R declines, then delta x minus m is positive. Then what happens if R increases? Delta x minus m?
It's negative. So
It's negative. So from here, aggregate demand will go down, right?
Yes, sir.
Yes, sir.
yes, sir.
Right. Anyone in the class who has a doubt about what I have said?
No, sir.
We can move over to the next slide.
Yes, sir.
Yes, sir.
So this is the diagram which I have explained. Now it should be very easy for you to see this diagram, right? What is in this diagram? The repo rate is increasing. This increases the money market rate. Now come first to the consumption channel. What is happening? Rate has increased, consumption has declined. Consumption has declined. Also, investment is in function of interest rate. So investment is also declining. So there is a reduction in demand, lower inflation. This entire thing is called interest rate channel. We explained this one by one, step by step in the earlier slide. Anyone who has any query about this one?
So by stronger
The second one is
exchange,
interest rate. I'll come to that block later. So
sure, sir.
anyone who is in credit channel, like say lower expected, lower expected profitability of firms and more difficult to get credit. That is also dampening investment. So this is the credit channel, which again we discussed. Now, what is stronger exchange rate? Stronger exchange rate means what? Stronger exchange rate means rupee is gaining. Rupee is gaining means the value of dollar is falling. So value of dollar, which was 75 for $1, is falling to 70. The price of dollar is going down. That is stronger rupee exchange rate. Is it okay?
Yes, sir.
Kritika? Okay.
Yes, sir.
So
It's
this
clear.
is called monetary policy transmission. When you are asked about monetary policy transmission, you have to only mention these three channels: credit channel, interest rate channel, exchange rate channel. There are many other channels, but these channels are most important. Have we understood how monetary policy transmission is done?
Yes, sir.
Yes, sir.
Yes,
So
sir.
anyone who
Yes, sir,
has
does
any, yeah.
so I
please.
have a question.
Yep.
So does
Souvik,
bank
please go on.
rates affects monetary transmission mechanism like mostly like in a greater amount, like in a greater quantum?
As compared to what? So if you
Sir,
are
as
saying
compared
greater,
to
it
the
has to
repo
be
rate.
compared.
Sir, as
See,
compared to the repo rate.
bank rate and repo rate is linked, right?
Yes, sir.
So if repo rate is changing, bank rate is also changing. So if repo
Yes,
rate
sir.
changes by say 30 basis point or 50 basis point or say 25 basis point, which is more common, it is declined by 25 basis points. So bank rate will automatically decrease by 25 basis point.
Yes,
So
sir.
they are linked.
Yes, sir.
But this is a
Okay,
very
sir.
interesting question. Okay. Anything else on
Okay.
transmission?
Thank you, sir.
Anything else
Yes,
on
sir. I have a
transmission?
question.
Anyone? Yeah.
Yeah, sir. I have a question. So, as we know that earlier in the banking system, we used to
Can
have
you please
bank
switch
rate,
on
but
your video
now,
when you are asking question? It helps me to kind of interact,
yeah,
Yeah.
sir. Yes, sir. So I have a question. Like earlier, we used to have a bank rate, but now we have a MCLR to improve the monetary transmission. So can you please elaborate on what is MCLR and why we have shifted to it rather than having bank rate in the older times?
Okay, fine.
And
Any
yes, sir.
other
And
questions?
how the transmission process?
Fine. See, bank rate is what RBI sets, right? MCLR is what bank sets. Okay. So
Yeah.
RBI sets bank rate or repo rate. RBI doesn't directly, RBI in its policy mention about the repo rate. Repo rate is the rate at which banks can borrow from RBI.
Yes.
After borrowing the fund, in what rate banks will give its consumer or the borrowers, at which rate their MCLR takes place. So this is determined by banks, and this is time to time decided by RBI. So these two are different.
Okay, sir. But sir, then why did we have
Any other question?
MCLR? I mean, if we were having bank rate only, then why did we have MCLR?
Again, you were having bank rate for RBI. For banks, you are having MCLR. because bank has to say that, okay, this is my repo rate at which I borrow. Over and above that, I will add a spread because of credit default of this person. Over and above that, I will add a spread for my operation cost, borrowing and lending, everything. And if bank rate is say 5%, then after adding all these expenses on my part, my rate will be 5% plus say a markup of 3%. So 8%. At 8%, I will give my loans for housing sector. So these are two definitions of the thing that I am trying to tell you. RBI is lending at a particular rate, but bank has its operational cost, bank has its credit rating of the consumer, you have your scores that how good a borrower you are. So there are credit costs. When bank adds up all these things, bank comes up with its MCLR. Then you can compare MCLR, that is the lending rate across different banks, and you can go to the bank which has the lowest MCLR, right?
Okay.
If you go, no one will lend you at repo rate or bank rate. Am I clear, Chetna?
Yeah, sir.
Okay. So again, repo rate is set by Reserve Bank of India, but you can't go to the bank and say that, okay, you this is the repo rate, so you give me loan in repo rate. Bank will say that, okay, in that rate, I borrow funds from RBI. Now I have a operating cost. I have a credit rating for you. You are a risky borrower or you are a safe borrower. So I will charge you this amount, and my MCLR is this. You can say that, okay, I'm not okay with this MCLR because some other bank is giving me a lower MCLR. So I'll go to that bank. Am I clear?
Yeah, yes, sir.
So MCLR is what you get from bank. You don't get loans in repo rate. They have to add something. Okay. Any other questions? Thank you, Chetna. So can we move on?
Yes, sir.
Okay.
Yes, sir.
Silence is good for me. But where are the other 30? I can only see 10 faces. Where are the other 30? Why they are not interacting? It is a 46% class. Now I want everyone to interact. Hi guys, where are you? Are you there with me? Yes, no,
Yes, sir.
what?
Yes, sir. Yes, sir. Yes, sir.
Okay, that is another 20. So next one, I want another responses from other 20. Okay. Thank you. Okay. So how can I achieve all these things? Interest rate changes. One is direct repo rate changes. Someone of you also changed that change in liquidity. So what is change in liquidity? You just simply reduce the amount of liquidity or amount of fund that is available with the banking sector in the interbank market. If the fund is getting reduced, the rate will go up. Or you can change the cash reserve ratio, which will make them to park more funds with RBI. So again, there will be a shortage created and rates will go up. These are some of the tools that we are using. So again, directly you can change repo rate. Or you may not change the repo rate. You just reduce the funds available to the banking sector. This how you do by OMO. You reduce the banking sector availability of fund. So if there is a scarcity, rates will go up. CRR is a portion that banks have to keep out of your deposit in Reserve Bank of India. Suppose CRR is 4%. Then out of every 100 rupees that you deposit in the bank keeps 4 rupees and 96 rupees it can lend. Now, if you make it say 6%, then bank will be able to lend only 94 rupees. This is equivalent to reduction in the fund. So again, rates will go up. I think this is okay with everyone.
Yes, sir.
Yes, sir.
Okay,
So I have a question on that. So we read in textbooks that the CRR is not frequently changed by central banks. So what is the reason for that? Why don't we change the CRR as frequently as other tools?
Okay, so any one of you have anyone who can answer this question? Who was this? Who asked this question?
Ramesh Pandan.
Acha, Spandan, very interesting question. So anyone from your class who can guess what will be the answer of this question?
If I were to take a guess, I don't know if it's correct, like a reserve requirement would require the banks to have that much fund available with them, which could take a bit longer in terms of transmission of the monetary policy than changing the interest rates, which is a bit more, takes less like logistical. Again, I'm not sure if this is correct, but if I increase the reserve requirement for banks, if the banks don't have that, it might take them some more time to gather that. I don't know if that makes sense.
Fine. Any other guesses?
Sir, I think that CRR is decided on the basis of how much money supply we need in the economy. So it's on the basis of that the CRR has been set by the RBI.
Very good. Anything else? Okay, let me answer this question. See, when interest rate operates, it's operating through the market. When liquidity changes operates, it's operating through the market. Supply of fund is going down, interest rate is going up. Market is deciding what should be the interest rate. Here, what you are doing, you are going to the bank and say that increase CRR. It's a direct instrument, it's an instruction. So as like everything, as like democracy, as like everything, we want people to decide what interest rate will come. So we want it to be decided by the large number of participants in the market, rather than Reserve Bank coming and said, okay, I am the regulator of the bank, I'm increasing the CRR from 4% to 10%. You have to keep the money. So the difference is between market determining thing and a direct instrument which is telling that, okay, nothing doing, you have to give this much of money. So in a way, we avoid CRR because of that, and we concentrate more and more on market determined tools. All central banks does that. But CRR have also been used when there is some urgency, when inflation is very high, when there is a CRR is also called as a prudential tool. You are asking banks to keep the money with you because if something goes wrong, you can come and intervene. So this is a very important question, Spandan. Thanks. Am I clear on this? Spandan, you are with me?
Thank you, sir. Yes, sir. Yes, sir.
Yeah. Okay. Now,
so one more question.
I go.
So when you talked about the market forces that determines the rate of interest, so in a way, is the RBI trying to intervene the market forces so that they come up with a desired number?
Okay, let's not talk about RBI. This lecture is more about general central banks. So yeah, central banks do intervene in the market, right? What is OMO? OMO is central bank's intervention in the market. By OMO, central bank is purchasing or selling government securities to either infuse liquidity or kind of drain liquidity from the market. So if you want to call it intervention current, you can tell it intervention. You
yeah,
can,
sure. So that is
kind of.
So that instrument,
yeah,
so that action of indulging in OMI operation, is that tool sufficient enough to get the desired result in terms of the desired number of the rate of interest?
Should be sufficient. No? So you do one OMO. Suppose what Fed does. So Federal Reserve Bank of India, sorry, not India, Federal Reserve Bank of Federal Reserve decides on what is going to be the federal fund trend. Now, New York Fed will decide that how much of OMO has to be done here in order to bring the market to federal fund rate. So suppose it does 100 rupees OMO, $100 OMO, it doesn't happen. Next day it will do $50 more OMO. So central bank can intervene and intervene and intervene to bring the interest rate to the Fed fund rate, right?
Yeah, sure, sir. Got it. So basically, it's done repeatedly.
Yeah, it depends. They all the central banks have a forecasting model which says that if you intervene by this much of OMO, then you will come to this. But then they can intervene and they can bring interest. That is the credibility of central bank. Yeah.
Sure, sir. Makes sense.
So I have a yes, sir. So I have a slightly related question. I wanted to understand: is there any tool which is like the effect of which is hardest to foresee? For example, like the central bank has a variety of tools at its disposal to control the money supply. So which tool, for example, like which tool would be the effect of which would be the hardest to foresee what will happen?
Hardest in the sense what?
In its effect. For example, we understand the open market operations directly reduce the funds that are in circulation, and CRR, as you mentioned, is a direct instrument. So the effect, the desired result that we're trying to achieve, is there any tool which is a little hard to implement, in a sense that we wouldn't exactly know if the desired result would be achieved to our liking?
Well, the transmission literature says that it takes some time. So if your markets are not, these are operating through the markets, right? So if the markets are not perfect, if there are not enough participants, then it might be hard to enforce this. But if the markets are liquid and there are enough number of participants, then it should be fine, right? There shouldn't be much trouble in doing so. That is why people again and again talk about developing. You will come across several documentation which talks about developing deep and sound institution based financial market. So deep means there are a lot of participants who are participating in the market, and sound financial markets in the sense that there are no frauds, there are nothing. Then in this kind of market, it is quite achievable, like say advanced economy markets. Our markets are also deep, but there are certain countries which may not have deep markets. There it will be very difficult to enforce, right?
Thank you, sir.
That answers your question, Ishita?
Yes, sir. Yes, sir.
Okay. So let us move over to quantitative easing now, because I want to see quantitative easing I wanted to cover, because when I am taking the overview, I want all of you to be in a level where you can pick up any literature in this thing and you can understand what is going on. Quantitative easing is a thing that is being used by central banks very often now. And if you pick up a newspaper everywhere, you will see that, say, that people are talking about tapering by US, people are talking about UK quantitative easing measure during the global financial crisis, during the pandemic crisis. This is going on. So what is quantitative easing? It's first started in 2001 in Japan for fighting deflation. It is used extensively by USA, UK, and Eurozone after the global financial crisis. When it is used, you please understand this one. Say this is your interest rate, and this is already near zero. So if you want to kickstart the economy, then how we will reduce the interest rate below zero? You cannot reduce it. So you make more and more money supply available. Had your interest rate been at 10%, you would have reduced it and kickstart the economy. But your interest rate is already very low. How can you do this? You can only do this by infusing money. You can only do this by putting money in the bank account of the spenders so that they spend. You can have some subsidy policy. You can have some reward policy. Those things can only work at that domain. There, the quantitative easing thing becomes a very important tool. So I want to again emphasize near zero rate. Okay, what exactly is this? It is coming and saying banks that, okay, you are holding assets, so you give assets to me. Against that, I will give you money, and that money you use for creating loans. Is it all good, good, good? No, it is not. It might lead to higher inflation, which may not be good for us. So we have to be careful that whether it is leading to higher inflation or not. USA inflation is already picking up. So all this discussion that whether they should continue with the quantitative easing or not is going on. Is it okay? Clear? Okay. So basically, if we come to India a little bit, what is kind of the things that we are doing? So we started monetary policy from mid-80s. If you see, there is a famous report called Chakraborty Committee report, and that came as the monetary policy there. From 85 to 97, it was flexible targeting of money. M3 was projected on the basis of the income growth rate and tolerable level of inflation. But then slowly we got more sophisticated, and we kind of look at the market forces. We saw that monetary policy doesn't work always. In 98, 99, RBI shifted to multiple indicators approach. So a lot of variables used to be considered, like growth, inflation, employment, financial stability, and everything. In 2016, we ultimately formally made a shift to flexible interest rate targeting, with inflation rate becoming 4% as a midpoint, and then 6% upper limit and 2% as a lower limit. And monetary policy committee is instituted. We are presently under this particular framework. Is that okay? This is just a timeline of RBI kind of a thing. So what is our operating target? Operating target is the overnight call money rate. What is call money rate? It is the overnight rate. If banks are borrowing for 1 day overnight, basically for meeting their fund requirement, then what is the rate in that market? Then what we change? We change the repo rate in bi-monthly policy. Some of you have already told. Reverse repo, basically repo rate basically depends on the interest rate structure. So we have a corridor system like this. In the middle, you have repo rate at 4%. Then you have reverse repo rate, which defines the lower corridor. And you have marginal standing facility, which is a kind of SOS kind of a mechanism where people come and borrow, and that defines the higher corridor. So are there any other instrument? Yes and no. Mostly interest rate are used, but there is a big arsenal of instruments that I have that RBI has. So it includes bank rate. Someone of you are mentioning the bank rate. You have SLR. You have central bank's communication. People give speech to tell the market what central bank is looking for and other. And then you have selective credit control also. For example, in recent time when there was pandemic, Reserve Bank said that some of the sectors it is trying to include under the priority sector lending, and it has actually included, for example, healthcare sector, so that they get more fund at this crisis time. All the PPE and the manufacturer of PPE, they got funds in a bit targeted way. So what are the limitations of monetary policy? There are many limitations. Again, when we discussed, we saw that there is long and variable lags. We discussed in the beginning, someone of you pointed out that there could be conflicting goals. Then there are fiscal dominance. Central banks accommodate government borrowing. Someone mentioned that fiscal policy should also be there in the domain of central banking. Central bank mostly operate in the demand side. See, when we draw this diagram, we didn't change the supply side. Supply remained what it is. So we adjusted the demand side. So if a problem is coming from supply side of the economy, central bank doesn't have much to do. And there are some unintended consequences also, like say a lot of money was infused during the global financial crisis. So subsequent, some spillovers came to emerging market countries. Taper tantrum was there where US declared that, okay, maybe we may not have that much of space, and these kind of volatilities that come up as an unintended consequence of monetary policy. So what is monetary policy? We took a 1.5 hours lecture. We interacted with each other and kind of we learned, it was a kind of both way learning. I learned something from you and we discussed certain things. So there are several ways people try to interpret monetary policies, like say Kidland and Prescott. They said that, okay, it is appropriate to have some rule rather than some person doing something or other. There is the Nobel laureate Taylor, and as you go higher and higher studies, you will see that Taylor rule will come in a big way. So Taylor said that if inflation is 1, then you have to increase interest rate by more than that, which is also known as Taylor coefficient. That's a rule he has given. And my favorite is Martin Feldstein, this comment that, okay, I sit in a plane. I know that there are 2 educated, well-known, well-equipped pilot who is driving me or flying me from one place to another. I would like to think also central bank is the set of that group of educated, well-known, who are continuously researching persons on whom I can depend. I am just sitting in a seat and I have the full confidence on those pilots. So they should drive me in and they should drive me out. Takeoff and landing should be smooth. And I am completely on their kind of knowledge and everything. So central bank should be viewed like that, you know. So this is another cartoon that I like. What is this? Someone is saying that is these are all, you know, nothing like this. It's fine. Ultimately, production increase, production decrease, demand increase, reduction, demand decrease. Everything happens from here. That's how we kind of change output and monetary policy. These are all, you know, it's okay. So that's also a view. So when we do central banking, you have to think that people might say that, okay, what central banks are doing and what thing. So we should be aware of that. There are a lot of criticism during the financial crisis that what Fed was doing, how so big crisis can balloon if central banks are watching so much. So it was a very interesting discussion, and I really didn't understand how 1.5 hours kind of flew. But then if I need to summarize, then what we have covered in this class, we have covered that what are the goals of monetary policy, what are the targets of monetary policy, what instruments central bank use, what are the dilemma in formulating the monetary policy, what are the limitations of monetary policy, and what are the goal, target, instrument, everything combined. If we have covered all these things, and if all of you are with me, where you can answer this, what are the goals of monetary policy, which we have seen, what are the targets of monetary policy, inflation. Yeah. Karan, yes. So what are the targets of monetary policy? What instrument central bank use that we have seen interest rate, liquidity, and we have also seen this one interest rate, liquidity, then CRR. How does this instrument work? You remember we have spent a lot of time on that diagram and the transmission channel to consumption, investment, net export channel. What are the dilemmas? Like where do we hesitate? How much time it will take, long and variable lags of monetary policy, by how much it is going to reduce the interest rate? These important questions. And what are the limitations we have also seen? So that was the main objective of the lecture. Now the floor is open. You can ask questions, and anyone who is running out of time or have some other appointment, please feel free to join those formally. This is what I wanted to share and discuss with you.
Hello,
Any
sir.
questions? Yep.
Sir, I had a general question. Like today we see that the COVID situation is really ruining the economy. So it's necessary that as one of the objective of monetary policy, we need to accelerate the economic growth. But as far as we know that the interest rate transmission is actually at a slow pace. So sir, I just wanted to have your views on like whether the repo rate of 4% is truly correct or not.
Okay,
Like,
see, I
to,
am taking an academic session, so I may not be in a position to give such an important view, but I would request you to go through the monetary policy that has recently come in RBI website, which may answer some of your questions.
Okay, sir, no problem.
Okay.
Yeah, thank you, sir.
Okay, so I want a quick feedback from the participants. If any of you are having any problem with these set of questions that I am summing up with, you please raise your question, or you just post understood and could be able to answer or deal with this question one yes in the chat box, so that I know that I have reached all of you.
Sir?
Okay.
So I have one doubt. Sir, so there's an impact gap when you implement the monetary policy instruments, right? So I wanted to know if the pandemic affected the gap, like increased or did the liquidity emergence of more players in the market, did it increase the liquidity so as to enable more efficient monetary policy transmission?
Pandemic, initially there was a knee-jerk reaction, but I think financial market picked up quite early, right?
Yes.
The stock market came back. That indicates that market players were back and markets were working fine.
Yes, sir. So I wanted to know if the impact gap did reduce or so there's a minimum time it takes for the policy to act in the market, right?
So I have to see whether there is any study on that.
Okay.
A priori, we need to see. We need to wait a little bit on the data releases. You know.
Okay, sir. Okay.
It's too early to conclusively say anything about what you are saying. Maybe after 1 year or so, we will be able to say.
Okay. Thank you, sir.
Okay, great. So I have responses from 29 of yours, 30 now. So I will wait for a few more minutes. If you have any questions, I would request you to please share your questions or.
So.
Yep.
Hello. Am I audible?
Yeah, please go on.
Yeah.
Yes,
So
sure.
so my question was is the effectiveness of sort of the like transmission of the monetary policy, are there any concerns going forward? I have heard like after the 2008 global financial crisis, after a few years after that, it was found that a lot of the US banks, they had a lot of money that sort of they didn't lend out necessarily. Like they had still a lot of money they could have lent out. And besides that, in a lot of countries like Japan, sort of more radical measures are being taken to sort of stimulate the economy, like negative interest rates and quantitative easing is being taken on is becoming a more regular phenomena. So like going forward, like is there any concerns like certain methods of monetary transmission will become ineffective, or like central banks might have to take more radical tools they might have to take?
Okay, at this point of time, it is very difficult to say that what reaction. Just hold on for a second. Hello? Hello? Yeah, I'll get back to you in 1 minute. I am taking a class. Yeah. Okay, so yeah, so see, only time can say that what will happen. We were in a pandemic situation. We tried to kind of, all the central banks, it was a coordinated policy decision between the central banks and the governments. All of us tried to salvage the pandemic. Now, as you are aware, there are several waves and several mutations. The pandemic is coming to us. The pandemic is kind of re-manifesting itself, if I may say. So what at this point of time, I can only visualize and say that we have to wait a little bit more to answer your question that whether it will be harder or not. It's too early to say about that. There are too many unknowns at this point of time. This is my honest kind of answer to your question.
Okay, sir.
Okay, great. So thank you so much for your valuable time. I will be happy and I will take this session as a success. If you remember the 5 things that we have concentrated on, that is again, what central banks are doing, what is its goal, what are the instrument it is using, how the instrument is kind of getting transmitted into aggregate demand, that is consumption, investment, and net export, and how it is reducing the price. Thank you very much. It was great interacting with you. Trust me, it was great interacting with you.
Can I come in for a minute? Yeah.
Yes, ma'am, please.
Yeah. Thank you so much, Mr. Ghosh. It was indeed a very, very enlightening session, I must say. I know in 1.5 hours time, you have almost touched all the areas of monetary policy. Monetary policy, it's a very, very vast topic, but in spite of that, you really touched every aspect. And really, I think even certain things, even it was for me also, I also got to learn a lot. I mean, as I've always said, I mean, going beyond the textbooks is really important. So I think what aspect you touched was important was how the interest rates, just we think it's just a change of interest rate, but then how it carries on that impact on demand, supply, investment, consumption, foreign exchange rates, export, import. So I think you brought in that interconnection between all the sectors, money market, goods market, and really explained it so well. So thank you very much for that and giving us time. And if I may just request 1 or 2 students just to tell in 2 sentences the takeaways of this session for them. Just 2 students, I want to do that. Quickly, come on.
Yeah, so to speak very briefly, I think the session was very enlightening in terms of monetary policy. And we got to know a lot of things even above and beyond what we learned in the textbooks. So yes, thank you, sir, for giving us a valuable time. It's truly a pleasure listening from you.
Thank you.
You're
Thank you,
most welcome.
Spandan.
Pleasure.
One more student would like to go?
Yes, ma'am, I would like to go. Personally, I have learned this topic monetary policy.
Can't hear you.
Can you hear me now, ma'am?
Yeah.
Yes. So personally, I have studied this topic in my BA second year. Today, the way you taught us in interactive session, I could visualize all those operations, like how OM works and how it affects the national income identity. So I could actually visualize how it works, which I couldn't before. So thank you for that. And it was very easy to grasp. I think that's the credit that's the credit goes to you for making it very easy and comprehensive. Thank you.
Pleasure. Thank you.
Thank you so much.
Thank
you, Mr.
Yeah. While sir was
Sir,
speaking
before the
about
session gets end and I lose this opportunity, I have a question, sir.
I doubt whether Mr. Ghosh has time now to answer all your questions.
So, yeah, it will be a pleasure to get back to you. It's an excellent class, a very interactive class. Thank you, madam, for giving me this opportunity. I'm indeed thankful to you. Maybe we can take up certain things in some future classes, because I have a meeting scheduled from 12:45 and already the phone calls started coming for me.
Yeah,
So,
I saw that, yeah.
So therefore, I have to close this meeting. But indeed, I would like to interact with you more, and it was a excellent session indeed. Okay, thank you very much, all of you, and especially madam for inviting.
Thank you so much. We
so
will
much, sir.
definitely like to have one more session from you for our students sometime later. Thank you.
Sure, it will be a pleasure. Thank you.
So can we get your email ID?